All right, let's dive right into this explainer and tackle the elephant in the room. Is trading just a quick lottery ticket, or is it a legitimate skill you can actually learn? For decades, people have looked at the financial markets and basically assumed it's just a giant casino for people in suits. But today, we're going to strip all that away and look at the exact nuts and bolts mechanics of how it actually works. Welcome to our Trading Basics Guide. In this explainer, we're breaking down the foundational concepts from Sagar Sinha's super comprehensive first class on trading. Think of this as your absolute ground zero. Honestly, whether you've never even looked at a financial chart before, or maybe you've dabbled and lost a few bucks, this structured journey is going to completely reframe how you think about buying, selling, and, most importantly, managing risk. So here is our roadmap for today. First, what is trading? Second, going long versus short. Third, trading versus investing. Fourth, risk and capital. Fifth, stocks versus crypto. And finally, a quick trading quiz to test what you've learned. Section 1. What is trading? Let's get right into the basics. To really answer that question, we have to understand the true value of the information we're looking at today. The creator of this course pointed out something crazy. If he packaged this in-depth content and sold it for, say, 20,000 rupees, and if even just 1% of his 4 million followers bought it, he could have made a staggering 80 crore rupees. Seriously. But instead, he's sacrificing that payday to offer it entirely for free. Why? Well, because the internet is literally crawling with scammers promising overnight wealth. By giving this foundational knowledge away, the goal is to help you build genuine, robust skills, so you actually understand the mechanics of the market without getting taken for a ride.
Moving right along to Section 2, long and short trading, or the two directions of profit.
You see, trading isn't just about that classic buy low and sell high mantra everyone repeats. There are actually two completely different directions you can trade in, and understanding both is what separates the pros from the amateurs. Going long is basically the traditional way we think about doing business. You buy an asset, you hold on to it, and you sell it when the price goes up. It's exactly like betting on your favorite team to win a cricket match. You look at the market, you decide you have a bullish view, which is just a fancy way of saying you think the price is going to rise, so you hit buy. It goes up, you sell, you pocket the cash. Pretty straightforward, right? But here's the flip side, and this is where beginners get incredibly confused. Going short. I mean, how can you sell something you don't even own yet? Shorting is what you do when you expect prices to drop. You actually sell first at today's high price, and then you buy it later at tomorrow's low price. Okay, this analogy brilliantly illustrates how shorting works. Think of it as the mango analogy. Imagine mango season just kicked off. Prices are sky high at 100 rupees a kilo today. But you happen to know a massive shipment is arriving tomorrow, which is absolutely going to crash the price down to 80 rupees. So, what do? You borrow 1 kilogram of mangoes from a friend and immediately sell them in the market for that 100 rupees. The next day, just as you predicted, the price drops to 80 rupees, so you buy 1 kilo back, you return the mangoes to your friend, and boom, you keep that $20 difference as pure profit. In the financial markets, your broker automatically acts as that friend, lending you the asset to sell today so you can buy it back cheaper tomorrow. All right, Section 3, trading versus investing. Active hustle versus passive wealth. As we move forward, we really need to untangle two concepts that people constantly mix up. They are absolutely not the same thing, and knowing your end goal is crucial before you risk a single rupee. The key takeaway here is that trading is an active, daily hustle. It's exactly like renting a shop. You got to open the doors every single day, analyze the market, read the charts, and manage your inventory just to generate a regular monthly income. Investing, on the other hand, completely passive. It's like buying a plot of land on the outskirts of the city. You don't wake up and check the land's price every single morning. You just let it sit and appreciate over decades for long-term wealth creation. So ask yourself, do you want a daily business, or do you want your money working quietly in the background? Which brings us to Section 4, risk and capital. Seriously, this is all about protecting your money. Pay close attention, because this is the absolute most critical part of our explainer today. If you don't learn how to protect your money, trust me, the market will gladly take it from you. Now, a massive myth that terrifies people is that you'll lose your entire life savings in one bad trade. But listen, that only happens if you're driving blind without brakes. In trading, your brakes are called a stop loss. Think about it. If you're riding a motorcycle on the highway and suddenly see a giant pothole, you don't just accept your fate and crash, right? You squeeze the brakes.
A stop loss acts exactly like those brakes, automatically cutting your position at a small, acceptable loss before a market pothole completely wrecks your account. It's your ultimate safety net.
Now, let's have a real talk about returns. If anyone on the internet promises to double your money in a month, run. Just run away immediately. That is a scam. To put things into perspective, the absolute best world-class professional crypto traders are making around 4 to 5% a month. Top stock traders? They're making about 2 to 3% a month. I know, 5% might not sound as exciting as double your money, but compounded over time, that is how true, sustainable wealth is built. No gambling required.
Okay, Section 5, Stocks versus Crypto. It's time to choose your arena.
So, with realistic expectations set and your safety brakes installed, you need to pick your playground. And the difference between these two is literally night and day. The stock market is like a nice, safe, regulated pond. It only deals with Indian companies, operates on super strict hours from 9:15 a.m. to 3:30 p.m., is closed on weekends, and generally has lower volatility. Crypto is a massive, wild, global ocean. It's open 24/7, 365 days a year, zero holidays. And it's not just crypto. You can trade US tech stocks, gold, forex, the whole shebang. But remember, the ocean has way higher volatility. That means bigger waves, bigger opportunities, but for sure, much bigger risks.
And before you trade in either market, you've got to understand how you are buying. Spot trading is super simple. It's like walking into a store, paying 10 rupees and walking out with a chocolate. You own the actual asset immediately. Futures and options, or F&O, is a totally different ballgame. It's like paying a 2 rupee non-refundable advance fee to the shopkeeper just to lock in that chocolate's price at 10 rupees for next month. You don't actually own the chocolate yet. You're purely trading on the prediction of its future price. F&O requires way less capital upfront, but it carries entirely different, often much higher risks.
Finally, Section 6, the Trading Quiz. Let's test your knowledge. All right, it is time to put everything you've just learned into practice with some real-world scenarios. Let's see if you can apply the logic of a pro instead of a gambler. Here's question 1. Ram shorted Bitcoin at 60,000. But the next day, the price went against him and spiked up to 65,000. He panicked and exited his trade. Think back to the mechanics of shorting we discussed with the mangoes. To enter a short, you sell first. So how exactly does Ram exit this incredibly stressful trade? Does he hit buy or sell? And more importantly, did he make a profit or a loss here?
Moving right along to question 2. A trader starts with a capital of 1 lakh. In January, they absolutely crush it and make a 50% profit. Amazing, right? But then, in February, they make some bad calls and take a 50% loss. So are they back to their exact starting amount of 1 lakh? Now this is a brilliant test of trading math. Your brain naturally wants to scream, yes, obviously, but I highly encourage you to pause and actually do the step-by-step calculations. The answer might genuinely shock you.
And finally, question 3. A beginner looks at Bitcoin swinging wildly all over the place and says, hey, this high volatility is great. It means there are massive opportunities to make a profit every single day. Is this beginner right or wrong? Consider everything we've talked about today regarding risk management, stop losses, and our analogy of riding a motorcycle on the highway. Is high volatility actually a beginner's best friend, or is it a devastating trap just waiting to be sprung?
I want you to calculate the answers to those 3 quiz questions and drop your detailed logic down in the comments below. Don't just guess. Explain your reasoning, because taking active steps to analyze and calculate is literally the only way you transition from a gambler hoping for a lucky break into a structured professional trader. The market? It rewards discipline, not luck. So, what was your absolute biggest takeaway from these foundational concepts? Let us know, and I'll catch you next time as we continue to break down the complex world of finance